Good afternoon, everyone. Welcome to the JKH Investor Relations Webinar for the first quarter of 2025-26. My name is Gihan Kure. I'm the Deputy Chairperson and Group Finance Director. I'm joined by our Chairperson CEO, Krishan Balendra, and the two of us will conduct today's webinar. The format, as we always follow, will be that Krishan will provide us an overview of the key economic highlights and the macro environment and some of the highlights of our key projects. And then I will take you through a presentation of our key financial performance for the quarter. And then we will open up the floor for Q&A. If you have any questions, I would like to remind you to please enter it into the Q&A tab at the bottom of your screens. With that, I'd like to hand over proceedings to Krishan.
Thanks, Gihan. Good afternoon, everyone, and thank you for joining our investor webinar. Just starting with the macro environment, the political environment continued to be very stable after the round of national level elections in the second half of 2024 and the local government elections earlier in 2025. We have continued to have a period of political stability. On the economy also continues to have very strong indicators, very stable indicators. I won't go into the detail because there is nothing new. Inflation is low. The currency has depreciated marginally, but generally stable. Reserves continue to build. Exports have been strong. So generally stable and improving economic indicators as well. The IMF, after their last staff review, were very complimentary on the performance of the economy, even describing it as remarkable. And then in early July, the fourth tranche was disbursed by the IMF after a board approval in early July, which is a relatively recent development. The macro environment in terms of consumption continues to be strong, a trend that we have seen in the last few quarters. Our consumer businesses, will go into the detail during the presentation, continue to see a good volume. The beverages business, there was some impact from unseasonal rain, but generally compared to a year back, the volumes continue to be stable, reflecting a healthy improvement in consumption. Tourism also continues to grow after the lows of COVID and after the economic crisis. So the numbers are back to pre-COVID. We use 2018 as a benchmark year. And for the first 6 months of the year, arrivals are slightly above what the numbers that we saw in the first 6 months of 2018. The outlook is very positive. The bookings we have in hand for the upcoming winter season are stronger than the bookings we had at this time last year for the last winter season. And with increasing flight connectivity as well, we are confident that the upcoming winter season will be much stronger than the last season and even stronger than the previous peak year of 2018-2019. On our new projects, the City of Dreams Sri Lanka will officially launch over this weekend. The Cinnamon Life Hotel has been operational since October last year. Occupancies have steadily improved. Each month is better than the previous month. July has been better than June, and based on bookings, we expect the trend to improve August onwards. And of course, with the launch of the City of Dreams Sri Lanka, we will also be opening the gaming space from this weekend, and the Nua Hotel will also be operational, open for business, as well as parts of the mall. The West Container Terminal Phase 1 is operational, as we said at the last review. construction and completion of phase 2 is on schedule, and we are confident, as we said the last time as well, that we will complete phase 2 by the end of 2026. Volumes, although the absolute numbers are still small, volumes so far have been ahead of plan. And while there were some initial teething problems with the automation, the efficiencies and turnaround times at the terminal are now doing very well and are on or better than planned. On our other new venture, BYD, we'll go into the detail, but volumes have been very strong there as well and ahead of expectations. So that's a quick summary of the macro environment and some of our new projects, and I'll hand over to Gihan.
Thank you, Krishan. I will now take you through the financial performance for the quarter. So looking at the EBITDA for the quarter ended 30th June, we recorded a strong performance during the quarter with EBITDA for Q1 being at almost 13 billion rupees, and that's a growth of almost 70% over the previous year. The growth was driven by mainly the retail business, which the supermarkets business had a strong performance, and the new business with the new energy vehicles also having a significant contribution towards the performance. But overall, the retail industry group did very well. With leisure as well, as you can see, our EBITDA, the loss that we had at an EBITDA level has now reduced, and I'll take you through the different components of that. And some of the other businesses also have shown an improvement, particularly with property. So overall, EBITDA performance for the quarter was strong. If you look at it over the last few quarters, Q1 typically tends to be a slower quarter because we do ramp up because of the seasonality with some of our businesses, leisure, retail, and so on, where Q3 and Q4 tend to be the stronger quarters. So if you look at it in terms of the momentum across the 4 quarters, you can see that the Q1 performance compared with the Q1 performance in the previous year is very strong. But on a quarter-to-quarter basis, like I said, Q4 to Q1 is mainly due to the seasonality that we have with some of our key businesses. If you look at it in terms of the exchange rate, we did see a slight appreciation of the rupee vis-a-vis what we saw last year, so from around 306 to 300 rupees. But in terms of the average exchange rate over the quarter versus last year was at around the same level. Looking at the finance costs for the quarter, there's not a whole lot to explain here, but if you look at it, we've seen rupee rates being lower. Across the different businesses, the finance costs have been largely in line, other than in retail and in our leisure business. So if you look at retail, the growth over last year is mainly with the new energy vehicle business, which has working capital or trade facilities. That's the reason for the increase. Whereas the supermarket business itself, the finance costs have come down. In leisure, the increase is really mainly on account of the fact that last year in Q1, City of Dreams Sri Lanka was still a project in construction, and therefore the interest costs were capitalized, whereas this year it is in the income statement. So that's why if you look at it vis-a-vis last year, if you exclude all the different exchange movements from around a 3.6 billion, you see the increase to 4.9 billion, mainly because of the Cinnamon Life or City of Dreams interest cost hitting the income statement as well. Looking at the PBT for the quarter, again, strong growth in our PBT numbers, both on a headline basis as well as if you exclude City of Dreams. So if you look at it at an EBITDA level, last year, Q1 to this year, there wasn't a very big difference in terms of the City of Dreams performance, because we had already started ramping up operations and we had staff coming in. But if you look at a PBT level, last year, because it was still in construction, the depreciation and interest costs, like I mentioned previously, were not factored in, and therefore the impact of CODSL at a PBT level was only about 2 billion, whereas in this quarter it's at about 4 billion with interest and depreciation. So despite that, the overall performance at a PBT level has improved to 3 billion over the marginal loss last time. But if you exclude COD against a 1.8 billion, we've seen a significant growth to about 7.2 billion on a like-with-like basis. Looking at some of our key balance sheet indicators, we've seen our total debt on a quarter-to-quarter basis, so Q4 to Q1, increase by around 15 billion rupees. But if you look at it at a net debt level, it's about a 10 billion rupee increase. And the reason for this increase is there have been some infusions as planned into Cinnamon Life. But apart from that, with the new energy vehicle business coming into play, we've also had the working capital and trade facilities, which is not really long-term debt, but it's just short-term working capital facilities. But that's why you see that increase in debt. In terms of our ESG, I won't go through the details here, but it's available in the presentation for review later if you'd like to go through it. Krishan already spoke of the West Container Terminal, so we started operations. So it's really the first quarter that we've had a full quarter of operations. So we started towards the tail end of the last quarter. Overall, it's progressing very well in terms of productivity. Whilst there have been teething issues as expected, those have been resolved very quickly, and productivity has scaled up very quickly and has now started settling down. So it's very encouraging on the operations front. And from a business perspective as well, naturally starting off from zero base, we've expanded each month over the other. We've seen significant growth, of course, of a small base. So just some images of how CWIT is now operational. We can berth 2 ships now with the yard space, the key length that we have, as well as the cranes. So just some other images as well. In terms of our overall volumes to the port, I'll just move to the next slide. If you look at SAGT, we saw a marginal decline of around 2% from last year Q1. But if you look at it, last year Q1, we did 516,000 TEUs, which on an annualized basis is over 2 million TEUs, which is sort of well above their capacity. So this is a very marginal decline, but the absolute volume of 508,000 is still a very high number. In terms of performance, though, the domestic to transshipment mix has been a little lower at about 10% compared with what we saw in Q4, though it's in line with Q1. So net, this does have an impact on revenue, which did have a marginal impact on the profitability of SAGT. CWIT, so like I said, it's the first quarter that we've been on operations. We've done close to 90,000 TEUs, which is above expectations. And as I mentioned, starting off very slow from April through May to June, we've seen very strong growth, and the momentum is very encouraging, and that number will continue to grow as we head into Q2. And we will also start seeing the domestic mix getting better as we get more ships calling in. The bunkering business saw volume growth of around 13%, and we saw margins improve as well. So overall, the bunkering business had a very strong quarter. And on a headline basis, though we've seen the overall EBITDA performance being marginal or flat, if you exclude the performance of CWIT, which is accounted as an equity accounted investee, if you eliminate that, the overall EBITDA of the transportation group increased by 11%. So just to remind you, we treat CWIT as an equity accounted investee, where we consolidate or take the share of PAT, so which naturally then includes the depreciation and finance costs. So just to give you a sense of what the depreciation impact is, and on a cash basis what CWIT's performance is, for the quarter there was about a $3 million depreciation charge, and despite that, as I mentioned, the impact on the financials hasn't been too negative. But as things ramp up, it's something we will continue to monitor and disclose. Our consumer business for the quarter was disrupted by some unseasonal weather during the quarter, during most of the quarter, where we had unseasonal rains throughout the months of April and May in particular. We saw, despite that, the confectionery business saw marginal growth in volumes of 3%, but the beverages business, which is typically more affected by weather, declined by 10%, which was similar to what the industry witnessed as well. So that 10% decline was something that other players witnessed because of the overall conditions in the market. As a result of the volume decline, we saw our EBITDA margins decline compared with last year. So it's mainly a operating volume or operating leverage that we've lost on, as well as we did have some investments on the launch of some new products and A&P spend. So we expect margins to recover, particularly with the weather now settling. We expect Q2 momentum to be better, particularly with the beverage business. So this is something we think it's more of an anomaly in Q1, and Q2 will see the performance normalize. If you look at it against the volumes, if you look at the volumes for Q1, it's a decline, as I mentioned, against last year. Of course, Q4 tends to be more seasonal, but with that type of decline, that's why there's an impact on the margins. With ice creams, of course, it's in line with Q4 and a slight growth, as I mentioned, over Q1 last year. Our retail business saw strong performance. If you look at the supermarkets business, we saw 13% growth in same-store sales. So if you look at it across the 5 quarters, we're seeing a similar sort of trend of strong double-digit growth in same-store sales, which is again driven mainly by footfall growth. So if you look at ABV has been negative, similar to the trend we saw in Q4, and I'll get to the decomposition of ABV in the upcoming slides. But overall, with this strong performance, we've seen our supermarket business EBITDA margins grow from 6.7% last year Q1 to 7% this year. Just to highlight though, if you look at it against Q4, we tend to have more of a seasonality in Q3 and Q4. So the margins are sort of against that number are lower, but if you look at it against Q1, it is a growth. If you look at the breakup as well, overall, we've shown you the impact of the electricity costs. We did see an electricity tariff revision that hasn't fully translated through in the quarter, but overall, I mean, that has not been as material as you can see over the last couple of quarters. So the growth in margins is really driven by the fact that overall volumes have been growing as well. Looking at the decomposition, as I mentioned, so same-store footfall has grown at 16%. It's driven by a combination of new customers coming into store, as well as the higher frequency from existing customers. If you look at our ABV, it's down mainly because the decomposition there is that we've seen the retail selling prices coming off due to the inflationary environment in the country, or deflation. And then we've also seen the weight of purchase reduce. Now, I think what's important to highlight here is that the weight of purchase, or the number of units that one buys, it has reduced not because of macro conditions per se, but it's also a factor that with the frequency of visits to the store increasing, the items in a basket of an individual sort of get split over that frequency. So it's that's partly the reason why the weight of purchase has declined. And that is also driven by some of the initiatives that the business has done to really drive footfall, drive more fresh produce, as well as more prepared food, where people's shopping behaviors then change, where the shopping occasions actually increase as a result. With the new energy vehicle business, we've seen orders of over 7,000 units, which has exceeded expectations, and this business has done very well. For the quarter, I think importantly, we've handed over 2,300 units or vehicles during the quarter, and the revenue that we've recognized and the profit recognition is on the basis of these 2,300 vehicles that have been handed over. We've also done a lot in terms of network expansion from our showrooms, as well as the charging network, with now around 20 of our Keells supermarkets having charging stations, as well as independent parties that have also started establishing the network, which will support what we are doing as well. Moving on to leisure, our arrivals into Sri Lanka have, of course, this is, just to remind you, is a period of more of an off-season. We've seen the numbers broadly in line with last year. This year we'll see growth. If you look at it, you are continuing to see growth, and numbers are now in line or getting better to, in line with pre-pandemic levels. And as Krishan mentioned, we are encouraged by the visibility of the forward bookings that we have. So we should see a very good winter season for the tourism sector in Sri Lanka. Maldives as well, we've seen growth in the numbers. And if you look at it overall, it has translated to better numbers across all our segments. So if you look at occupancy in the city hotels, we've seen occupancy increase quite significantly. ARRs have come down, as we had discussed even in the previous quarter. With the new inventory that's come into the city, rates have been somewhat under pressure, though we are quite confident that with City of Dreams as well as the overall tourism momentum, that these rooms will get absorbed, and as the inventory gets absorbed, that we will see yields improving as well. But overall, if you still look at it on a RevPAR basis and the impact on margins, we've seen from a marginal negative, the city hotels have seen an improvement this quarter. It's a similar story with resorts, where we've seen from a marginal negative, EBITDA margins have got into the positive territory, driven by occupancy again, though ARRs have been flat. And it's somewhat similar in the Maldives, where occupancy has been higher, and that has translated to better EBITDA margins. I won't go through the City of Dreams slide here, but as Krishan mentioned, we have the other components now coming into play, which really brings the entirety of the complex and unlocks its full potential, with most of the components now operational or will be operational from the 2nd of August onwards. At City of Dreams Sri Lanka, if you look at the hotel, of course, right now we are operating 687 rooms. The Nuwa Hotel just opened, so for the quarter we are really looking at the 687 rooms. The occupancy for the quarter was at 24%, with an ARR of around $100, where we had a conscious strategy of ensuring that we promote the product, particularly for conferencing traffic from overseas as well. And we've seen very good traction, and with the other components opening, we are quite confident that then occupancy will continue to ramp up. If you look at the financial performance over the last few quarters, you can see the performance in terms of EBITDA from the negative that we saw in Q3 has been steadily improving, though we had a loss of ₹1 billion for the quarter, but it's an improvement over the previous quarter. If you look at a PBT level, it's about roughly in line with what we saw in Q4, a slight increase in depreciation as different components come in, but broadly in line with what we saw before as well. Just some images of some of the other areas as well, and the Nuwa Hotel is also now operational. Moving on to the property business, we've seen good traction. Again, in terms of the number of sales at Cinnamon Life, we had around 6 units sold during the quarter and 1 office floor. Lot of inquiries as well, and as we've said over the last couple of quarters, we see increasing interest, and we are quite confident that this will translate to actual sales as the other components now come into operation. With Trizen as well, we've seen the number of units increasing over the last quarter, and Viman, which is our suburban residential project, has seen very good traction with phase 1 almost fully sold out and phase 2 also having a few units remaining. We launched phase 3, and that's also received quite good feedback and traction. And all that has collectively transformed from a loss last year for the industry group to have a positive performance in this quarter, which we expect that momentum to continue as we continue to hand over and recognize more revenue from sales. Finally, moving on to our financial services business. Union Assurance saw strong GWP growth of around 20%. If you look at the net profit, we did see a slight decline over the last year, and this is mainly on account of the investment that we had done in the bank assurance partnership, which we had disclosed earlier. So the shareholder fund base reduced as a result, and therefore the investment income that we get on that base has naturally reduced. But overall, that investment will yield medium to long-term results. And actually, when we get into the recognition of the surplus, which is typically done in Q3 annually, you see the impact starting to translate to that benefit. Nations Trust Bank, these are the same numbers that we had discussed in the previous quarter, so I won't go through the numbers, but the bank has continued to see strong momentum, and we will update the numbers in the next quarter once that gets disclosed. So that brings us to a close on the presentation. Once again, I'd like to remind you to enter any questions that you have in the Q&A tab at the bottom of your screen, and we'll open out for the Q&A session now. Krishan, if I may just open with the question, I think what's topical right now, as we spoke of the performance of the retail industry group and the NEV business, just in terms of JKCG, there's been some clarifications and questions on something that's been in the press. Maybe if you can just elaborate a little bit on that, please.
Yeah, there's been a lot of noise. We are engaged with customs on this matter. It's with regard to the power of the motor of one model in particular. We have, as we said in our statement 2 days back, we have said that we have certification from BYD, the manufacturer, and independent certification to confirm the motor power is what we have declared. So we are in discussion with customs. And we are working towards a resolution as soon as possible.
Thanks, Krishan. Just staying with BYD, there's a question on whether the initial order momentum has started to slow down, and just how many months of a backlog of orders are there currently?
Yeah, I mean, if you look at the last month, there really hasn't been a slowdown in the momentum, so it has continued. We expect to launch a few new models over the next few months, so that could help to maintain the momentum or improve the momentum. What was the second part of the question?
I think that sort of okay. I think covers it. It was about the order backlog, whether how many months of order backlog.
Yeah, I don't have an exact number, but with the sort of unexpected volume, the backlog is higher than we expected, and we've had to ramp up some of our workforce and other facilities to ensure that we can increase the speed of delivery so that we can reduce the backlog.
Thanks, Krishan. I think you sort of covered this, but the timeline for the Cinnamon Life Mall to be deployed, we did say that it will start off and ramp up, but maybe if we can just give a little more color on the rest of the mall.
Yeah, we expect that by the end of this calendar year, that most of the mall tenants who are committed will be operational, and the entire mall, because we have cinemas which are currently going to be fitted out. That would take longer. That won't be operational at the end of this calendar year. But a large part of the mall will be operational by the end of this calendar year.
There's another question on how will the mall be operated and whether it's operated in a similar manner to peer malls. I think it will be a similar structure that we follow in terms of our malls as well, where we act as the landlord and we are renting out the space to tenants. Some may have fixed and variable, some may have a fixed rental. So it's not too different to the operating model that we have for malls. Sorry, I'll just go back to BYD. I think it will be difficult to give color on this, but do you expect new orders to continue at the same pace into FY27? Or do you believe this will ease due to current pent-up demand?
Difficult, as I said. I mean, you would think that there could be some easing because the first few months there certainly was pent-up demand. At the same time, as I said, we are introducing new models over the next few months, so that could add to the demand. So really very difficult to forecast where we would be next year.
Thanks, Kishan. There's a question on whether there would be more significant pre-opening expenses coming before the August 2nd COD opening. There are some costs, but I think in terms of our normal marketing costs and so on, yes, there will be some costs that are linked to this launch, but it's not going to be that much more significant. And overall, with the type of ramp up we see, we don't expect that to be significantly negative in terms of P&L impact because of the revenue side. So also a question on the additional depreciation charge on COD when the rest of the segments come on stream. It will really be the Nuwa Hotel primarily, and whilst we can't give an exact number, it would be around maybe 20% or so in terms of a depreciation impact that we would see from where we are on a current run rate basis. There's a question on when the casino becomes operational, is there a boost to the EBITDA at City of Dreams? So naturally, as we spoke earlier during the presentation, it's not just the casino, but other elements coming in. Of course, with gaming operations, we expect the number of visitation to increase into Colombo and of course City of Dreams. And that in itself, apart from that, with all the other initiatives that we have in terms of driving conference traffic and so on, will translate to higher occupancy as we head into the next couple of quarters. And as I also said, as the inventory in the city gets absorbed over the next year or two, then yields will also go up across the city, which naturally will be a boost for EBITDA. And then from a rental point of view, the mall rental operations as well as the rental from gaming will start kicking in. Of course, that will take time for things to ramp up, but certainly over the next couple of quarters, we will start seeing the impact of those operations also contributing towards the performance of City of Dreams. There's also a question on pre-bookings comments for Nuwa. Yes, Nuwa is open now. So yes, it is. You can book it, but as with any city hotel, you don't really have a forward booking status. And of course, this hotel is managed by our partner Melco, and it will focus on the gaming customer as well. So a lot of it will be dependent on how that ramps up, where they would look to sell it as a sort of packaged deal. So in terms of forward bookings, you may not see it, but it really depends on how operations will ramp up. There's a question, Krishan, on whether we expect ARRs to recover in the Maldives. I think in the last quarter, we saw ARRs being flat or in line with last year, and what KHL can do to compete with the new hotels.
Yeah, the numbers continue to grow and in terms of arrivals to the Maldives. And yes, there is an increase in supply as well. But we expect, given the forecast for the upcoming winter and the bookings that we have in hand, that we should see an increase in ARR, marginal increase in ARR, but there shouldn't be, because of the new supply of rooms, there won't be a decline in ARR or RevPAR. And overall, as we've seen this summer, we are doing better than last summer, and we expect that this winter season, the main season, will also be stronger than the last winter.
Thanks. There are a couple of questions on the margins in the consumer food segment and I think volume. So I'll try and deal with all of these questions in one go. So as I mentioned, the margin impact is coming mainly from the volume impact. And I think there's a question also on understanding why beverages has come off because of weather patterns and why ice creams has been less affected. That of course is partly due to consumer behavior as well. But we typically see that beverages can be more affected by higher rainfall because people need to quench thirst and have a soft drink, maybe less so when it's raining. Whereas ice cream will still be consumed, and you also have the take home or the bulk segment where people will still buy ice cream and take it home, and therefore it's relatively less affected, though you still do see some impact on your single serve impulse segment. But overall, it's that impact of ice creams not being as affected by volumes by a 3% growth, and beverages saw decline. Overall, because of that decline, because of the lack of operating leverage, naturally you see that translate down to margins. And as I mentioned earlier, yes, we have had some higher investments in selling and distribution, advertising and promotions with the launch of some new products and so on. And that also did contribute to the decline in margins. There was also a question on whether there was any material contribution from the Reliance venture. As we've said in the past couple of quarters, it's sort of picking up slowly, but it's not something that we expect to have a material impact or contribution. And there are no investments or marketing spend that's through our P&L because it's a franchised operation. So short answer is no, there's no material impact to the CCS financials as a result. There's a question on how many supermarket outlets we expect to open in FY26. We hope to open anything between maybe 10 to 15 outlets, and we believe we are on track for that and should end up closer to the 15 outlets by the end of the year. In terms of the supermarket segment, there's a question on market share. We don't sort of specifically have a market share number, but what we do have is the comparison across the listed entities. And despite the sort of number of outlets that we have versus the, if you look at it against the three main competitors, our share, we hold more than certainly a lot more than our fair share in terms of market share. Krishan, maybe there's a question on explaining the current status of the Cinnamon Discovery loyalty program.
The program is active now and being ramped up. I would encourage to have a look at the website and look at joining the program. You will have different segments joining the program. As you know, we have the resort hotels in Sri Lanka, the city hotels in Sri Lanka, the properties in the Maldives, but we also have the restaurants, in particular in Colombo, now with the Cinnamon Life Hotel and adding a number of new restaurants and bars to the city that will also be part of the program. So we will ramp it up, but it is now operational and available for customers to join the membership.
There's a question on giving some insights, Krishan, on how the casino booking process will happen, whether it's pre-booked or on a walk-in basis.
Yeah, I mean, we don't operate the casino. We are the landlord. Now it would be a mix of existing customers of Melco, their loyalty base, so pre-bookings, but of course there will be walk-ins. So we expect a fair mix of walk-ins from tourists who are in the city, who may not be here specifically for the purpose of visiting the City of Dreams casino. There could also be guests who are here for the other casinos who may drop in to the City of Dreams casino. So while a number of guests would be pre-booked, I can't give a number in terms of the proportion. There will be a fair share of business from those who are in the city for other purposes but are looking for something to do in the evening, and even customers who come specifically for City of Dreams may drop in at one of the other casinos. So that's the kind of business, and I can't put a proportion of how much would be pre-booked and how much would be walk-in.
There's a question on gaming as well in terms of the square footage between what's back of the house versus the gaming floor. Maybe I can just give a rough number. It's probably about 2/3 and 1/3. There is some expansion space anyway that has been reserved for phase 2, but roughly that would be the mix. It's a question on whether we plan to raise more funds to complete COD. As we said before, when we did our last capital raise, we said that we don't expect or need to raise any further capital at all. That was really to fund everything that we needed to. COD is now essentially completed, but there were some financing obligations and so on, and the funds that we raised and the balance sheet that we have is more than adequate to take care of that. And now, of course, as you can see, the operational bleed is also reducing quarter on quarter. So certainly there is absolutely no need for us to raise funds to fund that operation. Krishan, there's a question on that we've mentioned that CWIT is expected to turn cash positive by the end of this or this fiscal year. Whether we could provide an indicative timeline on when we expect COD to break even.
As I said at the start, occupancy in the Cinnamon Life Hotel each month has been better than the previous month. And based on bookings we have and the momentum, that will continue. So August should be better than July, and September is better than August. So that is in terms of room occupancy, but also the banqueting spaces. Certainly there is a very noticeable pickup in each month as we go forward. The month of September is looking quite strong. We are seeing some foreign conferences and other events already booked for the rest of the financial year and beyond. And with the whole complex now operational, in particular with the gaming space, we think that it could help to even attract events, corporate events, because there is now entertainment available in the evening at a world-class level, and that can be an additional attraction to have a corporate event or conference in Colombo, and in particular at City of Dreams. So while I can't give a guidance of when we would have a EBITDA break-even at COD, I think I can say confidently that it will keep getting better with each month, and that is based on the visibility that we have now.
Thanks, Krishan. A couple of questions on whether, again, going back to CCS and some of the margins, whether the electricity tariff has been a key reason for the operational expenses at CCS. No, that's not really an impact because the tariff increase happened in June, so we are not anyway seeing the full impact of it, but it's more due to the reasons that I mentioned previously. In terms of the impulse segment, whether our focus would see us increasing the contribution from the impulse segment, certainly in terms of our product portfolio and development, that's something we've been focusing on. The NPD pipeline or new products also support that. And we've also had some other smaller investments that will continue to supplement the NPD process in this business. So yes, certainly we expect that continued shift and contribution from impulse to be there. There was also a similar question on expanding the manufacturing capacity in consumer and the capacity utilization. So overall capacity utilization is fine, but when it comes to certain products or certain segments, yes, we do need to look at certain investments. And as we sort of continue to grow our overall soft drinks volumes, not in the context of the decline we saw this quarter, which is more of an anomaly, as we will continue to monitor that, and depending on that, we will need some capacity expansions, which we will continue to monitor. But as I said, it's more linked to our NPD pipeline as well, that we will continue to look at increasing our manufacturing capability. Just moving on to back to leisure, Krishan, there's a comment on the long-term viability of the destination management business or Walker's Tours and the future business plans. Anything we could elaborate on that?
Yeah, I mean, this is even going back in number of years, there was a prediction that the destination management business could disappear with the improvements in technology and the online booking engines and online opportunities. But DMC businesses, not just at our group, but in some other groups, they continue to have good volume. And I think the destination management businesses have innovated, come up with new packages, new products, and enhanced their relevance in the context of the online opportunity and offerings that are available. And now, I mean, to take an example with something like City of Dreams, with an increased likelihood of corporate events and conferences, there is a role for destination management companies to play to plan out these events and to arrange the logistics for these events. And also, if you have higher end footfall and visitation because of projects like City of Dreams, there will be a demand for excursions and other visits. Example, flying to Kandy for golf. And these are opportunities for DMCs to arrange tours, offer special packages, special tours in Colombo and entertainment in Colombo. So I wouldn't be too hasty in predicting that DMCs will be badly impacted because of the online offerings.
Thanks, Krishan. Couple of questions on CWIT. There's a question on explaining the depreciation method and number of years. That's a little tricky because there are many different components there. So it's not one number. So for instance, something like cranes or equipment could be depreciated over a longer period, like 20 years. You will have maybe buildings in the site or based on the concession agreement. So the key wall and some of those investments will be in line with the period of the concession. So those are typically the significant investments which would be more long term. And then you'll have smaller investments which would be a shorter duration. So it really depends on the different components. But yes, the bulk of the larger investments would be more long-term in line with the useful life of the equipment itself. There's also a question on post-completion of WCT, when could we expect full capacity utilization?
Again, I mean, like the question on the cash break even at COD, I can't give a guidance, but what I can say, I commented that volumes, although in absolute terms are small, they are better than planned. And again, the outlook is positive. There is a lot of growth of volume in and out of India. In particular, indications from the shipping lines are that Colombo port overall will continue to see a good growth in demand, and the new capacity we expect will get absorbed quite quickly. And given the trends that we are seeing, we think that it will get absorbed even faster, possibly, than the new capacity that the last big terminal, the CICT, when it came into operations, the time it took for its capacity to be absorbed. We expect that the West Terminal may do better. So overall, volume, as I said, in and out of India, container volumes, it's still early days. Last year, there were like 20 to 25 million containers that came in and out of India. And if you look at China, last year, there were over 250 million containers. So, while Indian volume may not grow to the levels of China, you can see how much volume in India is likely to grow in the coming years. And there is going to be demand for port capacity.
There are a couple of questions which are maybe slightly more technical. So maybe I'll just run through some of those very quickly. There was a 2.9 billion cash inflow that's reported under investing activities due to a change of business combination. So that is really the consolidation of JKCG as a subsidiary, which was from Q1 onwards. There was also a question that, yes, initially, before we really started operations and sold vehicles or recognized revenue, but in last quarter, just for that period, it was recognized as an equity accounted investee, but we've been now consolidating it from the 1st of April, and that's why you see that number. In terms of eliminations under CCS, there's eliminations and adjustments under the CCS financials, which is mainly due to intercompany dividends, which are intercompany dividends that come from a fully owned subsidiary, which is the ice cream manufacturing company, which is also there, as well as our supermarket business, which is owned by Ceylon Cold Stores. So that's the reason for those two eliminations. In terms of sugar cost as a percentage of cost of goods sold, it's roughly 10 to 15% in terms of the CSD and ice creams business. There was also a question on how much equity has been infused into Cinnamon Life during Q1. It's about 5 billion rupees. So also a question on whether there are any other borrowings with capitalizing interest that's expected to impact the income statement from COD. There's nothing further as we've disclosed. So there's about a $200 million of debt at Cinnamon Life or Waterfront Properties, and that's the only loan, and all that the interest cost of that has been fully in the income statement. So there's nothing further to come in. Krishan, there's a question on the mall, whether Cinnamon Life will be a more premium ended mall compared to others, and will it be targeting mainly the gaming visitors?
Yeah, I mean, it would be a premium to the extent that there will be certain higher density of certain shops that will be targeting the gamers. So we would have more jewelry shops and proportionally more shops like the high-end watches and some other brands. So it's not a very large mall. The total lettable area is about 150,000 square feet, and quite some part of it will be taken up by the cinemas. But yes, so if I look at it proportionally, the higher end shops will be more than some of the other malls in the city, and they will be there to target the gamers in particular who will be coming for City of Dreams.
Staying with gaming, Krishan, there's a question on shedding some light on the second phase of the gaming operations. I know, of course, we are just about to start the first phase, but if we can give some light on that.
It would depend on footfall and how quickly the current space is taken up. The current space is quite large, and the moment we see the momentum and have the confidence, again, Melco are operating the casino, and then very quickly the second stage can be operationalized. Again, can't give a guidance on when we will do it, but we will watch the take up, and then the second phase can be made operational quite quickly.
There's a question on the FX denominated debt held by the company and whether these would be paid off in the near future or restructured. So as we've said before, the two main FX loans in the group, I spoke of just now, the waterfront properties where we have $200 million with the City of Dreams project. And the parent company has now around $155 million from the IFC loan. But at the parent company level, we've also consciously maintained a dollar cash balance. So we are actually net positive on our dollar cash balances by around $40 million. So if you look at it as a totality, the FX exposure will be that 40 million is a plus, less the 200. So it's about $160 million of a net exposure, if at all, that we have as a group. Of course, we have foreign currency denominated revenue streams at City of Dreams, which does offset that, though on an immediate basis, yes, there can be a mark-to-market impact if there's a depreciation of the rupee. This will anyway get gradually paid off as we have been doing. And as we've discussed before, the loan at Waterfront Properties is due for repayment or refinancing in December 2026, where most of it is actually a back-ended payment. And we will look at the strategy at that point of time, depending on how cash flows over the next 18 months ramp up, where we will then settle part of the debt. And if there's any need, we can look at refinancing at the time. There's a question on whether we expect the SAGT concession or contract to be renewed in 2029, Krishan.
Again, can't comment. I mean, we would like to renew it, but there is no movement. So at the moment, I can't say whether it would be renewed or not. So.
I think we've spoken of this before. There's a question on the expected returns to Waterfront from COD. So essentially what we've said is, as things ramp up, and particularly, of course, depending on how the gaming operations and the occupancy of the totality of the project ramp up, that we believe that it will then start heading towards sort of hurdle rates. It really depends on how the city and overall occupancy into the city also evolves. But if it does pan out in terms of how we think it could be, then certainly it will then head towards hurdle rates. In terms of ARR for Nua, we can't give guidance in terms of that, but naturally we have the ARR for Cinema and Life, and that will ramp up as yields get better. And the expectation is that Nua will be at a slight premium to that. There's a question on any new developments in the property segment in the suburban area. So right now we've got the Viman project. We've launched 3 phases. There's a 4th phase as well. And, it's been received very well. And based on that momentum, yes, we can certainly consider whether we need to look at something else, but there's quite a bit still in the pipeline that we can and will continue to work on. There's a question on the charging stations at the Keells outlets contributing to group earnings. It's really more about how this supports the sale of the vehicles. While yes, this can be something that can contribute. The model that we're looking is we are also partnering with people, so it's more of a rental model that we may follow and not necessarily invest and looking at the revenue model per se, but it will be a combination and we'll continue to evaluate that. But at this moment, we're looking at more in terms of supporting the initial development of the infrastructure itself. Finally, I think there's one last question I'll take. I think we've covered most, if not all, the questions today. Apologies, we've run through some of them quite quickly, given the number of questions we had to address. There have been some price increases in the beverage and frozen confectionery SKUs, and whether we expect any volume or market share impact. I mean, it's something we continue to look at in terms of our margins and the cost inputs. There was also a question in terms of whether there were any key raw material, the inputs that we had saw cost increases. One particular price increase that we saw was the prices of cocoa during the quarter. And so when we see those sort of price increases, we do take initiatives to ensure that we maintain our margins. We don't expect that to really have a significant impact on volumes or overall sales. So we expect the momentum, like I said, with the weather patterns normalizing, for volumes to start recovering. So that brings us to a close on today's proceedings. Thank you to everyone for joining today. The link for the webinar will be up maybe in a couple of hours time or by the end of day today. Thank you once again for being with us. And thank you, Krishan.